Do something original. Don't follow the pack.
What's your thoughts on the new research paper published called Expected Political Outcomes in Currency Markets? I haven't read that. Oh, this article will tend to become a bit math heavy. It's option after all, but what really is worth understanding is the D1 plugs into CDF and gets you your delta, and if you adjust it for time and volatility, you get D2, or the probability of the option will expire in the money. We can see quite simply how D1 and D2 with a quick adjustment. I'm writing down questions right now. Aspiring quants can giving a basic code example here, so you can go ahead and make that math up there in the code, not too hard, which produces this plot here. Implied probability density function of price to expiration. We do a few modifications to this as we then also look at the probability that the price will end up with 100 within 100 and 1000 of each strike for ETH and BTC respectively, but I will touch on this in a later article. Improving on this, it's not a terrible method for estimating the probability that prices will be within the X amount of strike, but when it comes to uniform distributions, we get a pretty terrible job. That said, we do capture bumps in the curve, which I personally think are valuable. For the sake of uniformity, we will assume a log normal distribution and weight by the bid-ask spread. Absolutely. Shoot me links, bro. Shoot me links, dude. I'm always interested in learning more. There's some earlier computation here, but this gives us the below plot for 31st of May 2024. This isn't so presentable, so we will of course add a bit of fun to the plots and show it all the next section. Alpha Academy. Thank you, dude. Is there a Dropbox for white papers like this? Quant Secret? Nice, dude. Thank you. Keep sending them. This is algos.org. I'm reading through this to see if we have some good questions for Homeboy. Um, yeah. What the market thinks. Here's our probability distributions estimated from our more naive approach to things like plainly uses D2. Okay, so he's using options here in crypto. These plots are nice and all, but they don't tell us an awful lot in intuitive terms about where the price will go. So it isn't easy. So it isn't so easy to visualize. Probability BTC is within 1000 of strike price across expiries. Plotting our mixture model approach. Yo, thank you, Rando. Thank you, dude. I'm gonna look at all these. I'm gonna put it all on a sheet or something. There are many caveats to note here, and they really should not be ignored. The first is that we do not believe that the market implied volatility will be the realized volatility of the market. To estimate this, we would need to do work on estimating the realized volatility against the market's implied over time and infer from this a rough guess of the true implied distribution. The distributions also had very fat tails because we have out of the money options which are not being weighted down in their presence. We can see below how illiquid options form a large part of the curve. We would be better served by fitting a least squares spline and weighting by bid-ask spread in our distribution. This is algos.org. Algos.org. Least square splines will tend to overshoot with sparse data, however, and so we would prefer to use Fengler's method, which preserves convexity and monotonicity of the implied volatility surface. I'll demonstrate this some other time. There's much more on this topic, and many methods exist. Log normal mixture, stochastic collocation, Andreessen Huge, Butterflies method, Breeden-Litzenberg. These methods are often used by real practitioners. We'll dive deep in a later article. In the meantime, feel free to check out this prior article where we dove into splines for options with a focus on market making. Algos.org, dude. Small trader alpha, perpetual arbitrage. Okay, this I like this one. The most liquid way to trade in digital assets is through the perpetual markets. However, they're not precisely the same instrument, even if they have the same ticker. So this adds quite a bit of complexity to the equation. We'll tease some P&L. This is one coin only between two exchanges and top of book. The shape is the part to focus on. The scaling part is trivial. Nice, dude. This looks great. Mid-price spread here. Okay, index, introduction, index, part one, basics. Overview of perpetual stablecoin basis, normalization of contracts, implementation, data scraping, pre-processing, checking for opportunities, taker back test. Part three, advanced trading, maker taker execution, volume and lead lag, latency, mean estimate, conclusion. Basics. To start with, it's worth mapping out the trade and how to achieve a simplified version of it. These don't work so well in the modern market, although they did previously. But that's why we have the advanced trading section to get readers up to speed on the state of the art overview of perpetual exchanges. Like most of the trades we've covered, perpetual arbitrage has a statistical element to it. In fact, it's not even technically a pure arbitrage and is counted as a statistical arbitrage, although it relies on mechanical forces which pull assets back together. Unlike a purely statistical trade, here are effectively betting on the convergence of two perpetual contracts likely cross-exchange. It mimics pairs trading in the regard that we have some entry threshold for the spread and an exit thread, usually the mean. And similarly, we use methods from pairs trading to time this spread. In the below sketch, we can see the cross-exchange prices of two Solana perpetuals on different exchanges. So cross exchange PXs of Solana perps. Can you explain? Sure thing. The ORC wing model and the SSVI model are both popular methods for fitting options in cryptocurrency markets. There you go, dude. After seeing this, give the fellow a shot. Hear what he's all about, Mr. B. Skipster says. Uh, One, how have previous... I'm going to go ahead and copy this question. Put in all your questions you have for Homeboy. All your questions you have for Homeboy, and I might bring him on. I might bring him on, dude. I want to keep reading through some of this stuff with you, and if you have questions, just throw them in the chat. Give the fellow a shot. Hear what he's all about. I want to hear your questions, dude. Mr. B, thank you, dude. Throw your questions in. If we get enough questions, I'll bring him on. If we don't have enough questions, I'm not gonna bring him on. I'm not gonna waste our time. How have previous experiences with the options trading influenced the author's current understanding of market dynamics? Okay. I'm going to list all your questions and we'll try to get all of them answered. Any info will be great. Which site? This is algos.org. Thank you so much for all these links, dude. I'm gonna save all of these here and read through, or not read all of them, but
No, it's what's
skim
called
them.
machine learning.
See which ones are dope.
So you find things that are predictive. You might guess, oh, such and such should be predictive, might be predictive, and you test it out in the computer, and maybe it isn't, maybe it isn't.
Maybe it
You
is,
test it
maybe it
out
isn't.
on long-term historical data and price data and other things, and then you add to the system this if it works, and if it doesn't, you throw it out. So there aren't elaborate equations, at least not for
3 things that are important to notice are perpetuals use